This past week was rough on all of us. With the bloodbath of corrections that happened, trust me, although it may look bleak now, there is a silver lining. This is just the beginning of so many opportunities for all of us. Let me tell you 6 things you can do to benefit from this and come out stronger on the other side. Come on in, let's talk about it. What's up, everyone? This is the Real Mark Cruz, and I'm here to keep it real with you on the things that matter the most, like your money, your mind, and your time. Before we get started, I have to let you know I'm not a financial advisor, okay? I'm just a dude on the internet. This video is for entertainment and educational purposes only. This last week was brutal. Tons of stocks took nosedives, and some even fooled us into thinking they were recovering, and poof, they started to dip again, just like that. Even some of the safest blue chip stocks decided to get into the party and took a dive off the deep end as well. Is it all doom and gloom? Nope, not at all. This is your opportunity to get ahead when the market isn't looking. Let me explain to you why. Believe it or not, the market was definitely overdue for a correction. I know it's been on a good run overall since spring of last year, but as the old saying goes, what goes up must always come down. In terms of stocks, it's actually a healthy thing. If stocks didn't show any type of support or resistance, they would have a higher chance to drop instantly. That's not good for anyone. But luckily, when it's on the way down, you are presented with a number of opportunities to grow your portfolio. When the market decides to misbehave, train yourself into seeing it as a good thing. When the market is red, see it as a sale. It is time to jump into your favorite stocks when they are on clearance. Load the boat as much as you can, but always remind yourself that dips are for buying. It also gives you a chance to dollar cost average on stocks you may already be in. For example, if you're in a stock for $25 and if it drops to like 17, initially, and even further to 14, if you buy more shares at each drop, your overall cost for your positions will be averaged down as well. What does this mean? It means it's easier for you to see green sooner when that stock eventually begins to run up again, due to the cost averaging at each buy level. One of the most reliable things I do when the market is down is I diversify my positions. I generally don't like to be invested solely in one brand or heavy in a particular sector of the market in the event that either are on the decline. I like to spread out my investments, so if some are down and some are up, the hope is that they will balance each other out and lessen the blow of the correction taking place at that time. There are times to trade and there are times to invest. In other words, I manage my portfolio so I have a set amount set aside for quick or swing trades and a separate amount for investing in stocks I plan to hold for long term, like for years. During corrections, I usually invest more in terms of long term stocks because if you zoom out and you don't look at the correction so close, eventually a lot of these long term stocks will rise again. And that is when most of us will look back and wish we could have brought more. One thing that is terrible for you to do is to compare yourself and your portfolios to others. Unfortunately, it is all too common during corrections and dips for people to post up their massive gains and show you how they outshined the market when everyone else didn't. How convenient, right? Ever notice that there are times when you are up and they are super quiet about their trades? You know why, right? It's because they drained their portfolios on a bad move and no one likes to show when they lose, do they? People will always attempt to show you the best parts of their trading activity, but not many keep it real when they screw up. Trust me, we all make bad choices. You're not alone. That's how the market goes, my friends. Sometimes you win, sometimes you lose, but feeling bad because someone is doing better is a dangerous thing to do. Let that thinking go immediately. On a similar note, another dangerous thing you may feel inclined to do is FOMO buy or YOLO buy a stock. You never want to buy anything under stress because you don't want to feel like you're missing out, or you never want to buy a stock because you're like, screw it, I only live once, right? I mean, there are rare instances where that may work temporarily in your favor, and it can feel great, but as a long-term strategy, it's the equivalent of setting your account on fire. That's not good. Don't do it. One of the things I do whenever something like this happens is I take the time to focus on enhancing my trading skills and knowledge. Trading is something that is hard to master since there are so many techniques and strategies we can learn. Use this time to brush up on your technical analysis skills, for example, or to learn in-depth options trading strategies, or learn more about dividend-paying stocks. The last thing that helped me when I first began to trade is that when the market is losing its collective mind, one of the best things to do is simply just to sit it out. You'd be surprised how effective sitting it out can be in preserving your portfolio's health and longevity. You might feel like too many plays may pass you by, but the beautiful thing about the market is that there will always be other plays for you to get into. There is never a shortage of them. Keep that in mind. Well, that's what I have for you guys today. If you'd like to get in on the trading train, feel free to use my Webull link in the description below to get 2 free stocks after you deposit your first $100. You can get into pre-market with us before anyone else does, and trade when the market closes too. With that said, keep your head bright, your wallets tight, and grab your dreams like it's your right, my friends. Peace.